So imagine having like $150 billion just sitting in your checking account.
Right. Not a bad problem to have.
Yeah, seriously. And you're managing one of the most profitable entities on the planet. But when it's time to pay out a routine dividend to your shareholders, you decide you're not going to touch a single cent of your own money.
Which sounds completely wild.
Right. Instead, you just walk into a bank and borrow $15 billion to cover the bill. On the surface, I mean, that sounds totally irrational. Why would anyone with that much cash take on massive debt? But Apple did exactly that.
Yeah, and, it seems counterintuitive until you look at the underlying financial architecture. That decision wasn't driven by, a lack of funds or anything.
Right. They had the money.
Exactly. It was a highly calculated move to avoid triggering a massive corporate tax liability because the money they had was parked overseas, and bringing it back would have cost them billions.
And that gets right to the heart of what we're doing today on this deep dive. We're exploring the ultimate financial scorecard, the balance sheet. We're using this really comprehensive accounting text, specifically Chapter 1, to kind of translate this stuff.
Yeah, because if you're evaluating an investment or running a business, it's easy to just view these documents as, a mind-numbing wall of numbers.
Oh, totally. Just an intimidating spreadsheet.
Right. But our mission today is to look past that raw data. Reading a balance sheet lets you see the hidden realities behind a company's public image. It cuts right through the marketing department.
Yeah, it reveals their actual strategic maneuvering. So before we look at the corporate giants, let's establish the rules. The balance sheet is basically just a snapshot frozen in time, right?
Exactly. It captures a specific moment, usually the last day of a quarter, and it lays out two fundamental realities. First, everything the company owns, which are its assets.
Okay, they ask.
Right. And then every claim against those assets. So those claims are divided into liabilities, which is what is owed to outside creditors, and then stockholders' equity.
Which is what actually belongs to the owners.
Okay, so let's unpack this core equation because it dictates, everything else we're going to talk about today. Assets equal liabilities plus stockholders' equity.
That's the golden rule.
Right. Let's bring this down to a relatable scale for you, the listener.
Right.
Say you decide to buy a house for $400,000. You put down $100,000 of your own money, right? That's the equity.
Yep, you're skin in the game.
Exactly. And then you take out a $300,000 mortgage, which is the liability. So the asset, the $400,000 house, perfectly equals the bank's claim plus your claim.
And if we connect this to the bigger picture, the structure is identical at the corporate level. That equation never, ever goes out of balance.
Really?
Never, never. Every single forklift, every manufacturing plant, every dollar in the checking account, it has to be financed somehow, either by borrowing or by the owner's equity. Okay, let's unpack this a bit more. Does that mean a massive corporate balance sheet is really just a giant, complicated mortgage? Is it actually that simple?
Well, not quite. I mean, the scale introduces layers of complexity that a regular homeowner just never deals with.
Right. Like what?
So for a corporation, the borrowing might be issuing thousands of bonds to public investors. And the equity isn't just a down payment. It includes decades of retained earnings that the company chose to reinvest.
Ah, okay, so they're pumping profits back in instead of paying them out.
Exactly. The balance sheet forces a company to prove that money didn't just magically appear out of nowhere.
Which brings up this really fascinating concept because tracing that value introduces a sort of a time-bending illusion. Before we can judge what a company owns, we have to understand when they record the things they buy.
Yeah, this is a huge one.
There is a massive difference between an expenditure and an expense, right?
Oh, definitely. This is where a lot of casual observers get lost. An expenditure is the physical reality of cash leaving your bank account. You write a check for a $100,000 piece of machinery.
And that cash is just gone today. Boom.
Right. But for accounting purposes, you do not record a $100,000 expense this year.
Because, if you did, it would make this year's profit look artificially terrible.
Right.
And then the next 4 years would look fantastic because you're using the machine for free.
Yes, spot on. That is the driving logic behind the matching principle. Accounting rules require companies to match the cost of an asset to the time period that it actually helps generate revenue.
So if the machine lasts 5 years,
the company will spread that initial cost over 5 years.
They chop it up. So they take a $20,000 expense every year for 5 years. That's depreciation, right?
Exactly. And depreciation transforms the balance sheet from just a simple cash register into a deliberate timeline of value.
Wow. Okay, so it's not just cash in a vault. It's keeping score of value that is slowly vanishing.
Right, the cash was spent on day one, but the expense is carefully meted out over time.
Okay, with the rules of time established, let's pivot to the assets themselves, the things a company actually holds. And the text points out these are always listed in a very specific order based on liquidity.
Yeah, which basically just means how fast can you convert this asset into cold, hard cash?
Right, so at the top of the list, we have cash and marketable securities. And marketable securities are just, what, short-term safe investments.
Yeah, like treasury bills. They basically act as a parking lot for excess cash.
And the sheer volume of cash being parked by major tech giants like Apple, Microsoft, Cisco, Car, it's staggering. We're talking about cash hoards in the tens or hundreds of billions.
It really is unprecedented.
But my instinctual question is, why? Like, if you are sitting on that much capital, shouldn't you be building new factories or researching new products or, I don't know, buying out competitors?
You would think so, but they often generate capital way faster than they can effectively deploy it.
Okay, sure, but why not just give it back to the shareholders as a massive dividend?
Well, look at who the largest shareholders actually are. They're typically the multi-billionaire founders and early executives.
Oh, right.
If the company issues a massive dividend, those individuals suddenly face an enormous personal tax liability.
Mm-hmm.
They don't want to trigger a taxable event that forces them to hand over, a third of that payout to the government.
Wow. So the company just holds the money, earns a modest interest rate, and the founder's wealth continues to compound tax-free on paper.
Exactly.
So the balance sheet is essentially being dictated by the personal tax preferences of a handful of billionaires.
Yeah.
That is a crazy way to look at corporate savings.
It really is. It changes how you see those numbers.
Totally. Okay, moving slightly down the liquidity list, we hit accounts receivable. So this is money that customers owe the company. You delivered the product, but you gave the buyer 30 or 60 days to actually pay for it.
Yeah, and extending credit like that is fundamentally a sales tactic.
Because if you demand cash on delivery and your competitor offers a 30-day grace period, you're going to lose the sale.
Exactly. The credit isn't just some administrative delay. It's a competitive weapon to win market share.
But that weapon definitely cuts both ways, right? It introduces the risk of default. Some people just aren't going to pay.
Right. And analyzing a company's accounts receivable reveals this fascinating nugget from the text. It's a classic application of the 80-20 rule.
Where 80% of a company's late payments come from just 20% of its customers.
Yes. And those customers are almost always the smallest accounts. They place tiny orders, they haggle over price, and then they drag their feet for 90 days before cutting a check.
Which is awful for business.
It is. The administrative cost of chasing down those small debts entirely wipes out the profit margin on the sale.
So if you're running this business, what's the strategic move? I mean, you can't just stop selling to small clients. You'd hurt your revenue.
The most efficient strategy is to just stop acting like a bank for them. You force those smaller, riskier clients to use a credit card.
Oh, wow. So you let the credit card company take on the risk of default.
Exactly. The company pays a small processing fee, sure, but they instantly clean up their balance sheet and guarantee their cash flow.
That is so smart. You just shift the burden to someone whose actual business is managing debt.
Right.
Okay, let's keep moving down the list to something physical. The warehouse. Inventory. This seems pretty straightforward, right? You just count the boxes. But counting boxes isn't as simple as it sounds.
Not at all, because prices fluctuate over time. So valuing that massive pile of identical items involves a huge accounting illusion.
Okay, so how does a company value a massive pile of identical items bought at different prices?
It comes down to a choice of methodology. The two most common are LIFO and FIFO.
LIFO and FIFO. Last in, first out, and first in, first out. Let's use the text's example, but visualize it. Imagine a company that sells gravel, and they just have a massive silo.
Okay, I like this.
All year long, they buy truckloads of gravel, dump it into the top. Now, inflation means the price of gravel keeps rising all year. So the gravel at the very bottom, from January, was incredibly cheap.
Right.
But the gravel sitting at the very top, from December, was much more expensive.
That visual perfectly frames the dilemma. When a customer brings a truck and you open the chute to sell them some gravel, how do you calculate the cost of what you just sold?
Okay, if we use FIFO first in, first out, we assume we're opening a trapdoor at the bottom of the silo. We're selling the oldest, cheapest gravel first.
Which means your cost of goods sold looks very low on paper. And if your costs are low, your reported profit margins look incredibly high. You look wildly successful to investors.
But wait, there's a catch, right? If my profits look high, the IRS is going to tax me on those high profits.
Exactly.
So what if I use LIFO instead? Last in, first out.
Under LIFO, you assume you are scooping gravel off the very top of the pile. You are selling the newest, most expensive inventory first.
Oh, I see. So my cost of goods sold shoots up and my papal profit shrinks.
And because your reported profit shrinks, your corporate tax bill drops significantly. That is the entire reason companies choose LIFO during periods of inflation.
That is wild.
It's a legally sanctioned method to make your business look less profitable to the government, so you preserve your actual cash.
Simply choosing a different accounting method radically changes your tax bill. But inventory gets even crazier when we talk about write-downs, right?
Yes, what's fascinating here is that sometimes the market forces a decision on you. It's called lower of cost or market.
Okay, what does that mean?
Normally, you list your inventory at whatever you paid for it. But if the global market price plummets below your cost of production, you can't pretend your warehouse is still full of gold.
You have to erase that value immediately. The text mentions the 2014 to 2015 oil crash.
Right. An energy company spends $60 to pump a barrel of oil. They store it. It's a $60 asset on the books. Then the global price crashes to $40.
Even though the oil is just sitting in a tank, totally unchanged.
Exactly. But accounting rules force them to immediately erase $20 of value per barrel from their balance sheet.
Which can be catastrophic if they use that inventory as collateral for a bank loan. The bank might call in the loan.
Exactly. It can trigger a real-world liquidity crisis, which is actually a perfect transition to the other side of the ledger. We've seen what they own. Now let's flip it. Who financed all of this?
Right, the liabilities. These are basically categorized by the ticking clock. You've got current liabilities like accounts payable within a year.
Yep, suppliers, short-term loans.
And then long-term debt like bonds. And there are some really exotic instruments here like zero coupon bonds.
Yeah, a standard bond is an interest-paying loan. You lend money, get annual interest, then get your principal back. But a zero coupon bond pays absolutely zero annual interest.
So why on earth would anyone buy it?
Because it's sold at a massive discount instead. A company issues a $1,000 bond but sells it to you today for, say, $400.
Oh, okay.
You hold it for 10 years, collect nothing, and at the end, they hand you the full $1,000.
That's a brilliant cash flow maneuver for the company. They get capital today, but don't drain their operating cash every month paying interest.
Right, they push the entire burden into the future.
And then there are subordinated debentures, which is just a fancy term for junk bonds.
High-yield bonds, yeah. If a company goes bankrupt, there's a strict hierarchy of who gets paid. Subordinated debt holders are at the very back of the line.
Which means they take on way more risk, so they demand a much higher interest rate. Okay, here's where it gets really interesting. Let's loop back to the hook from the beginning.
The Apple loophole.
Yes, the ultimate debt loophole. Apple had over $150 billion in cash, right? But they borrowed $15 billion to pay a dividend.
Right, because that cash was earned overseas. To bring it back to the U.S. to pay dividends is called repatriation.
And doing that would trigger a huge corporate tax rate, like over 30% at the time.
Costing them billions. It was literally cheaper to borrow money in the U.S. from a bank, paying a tiny bit of interest, than to use their own overseas cash and pay the IRS.
So the balance sheet really just reflects high-stakes tax maneuvering, not just normal business operations.
It's a masterclass in financial engineering.
Yeah.
And that kind of engineering leads us to the ultimate metric investors look at, which can completely fool an untrained eye.
Oh, earnings per share. EPS. Let's walk through the text's example of this because it's striking. Say in 2015, a company makes $1,000 with 1,000 shares.
So the EPS is $1.
Simple enough. But in 2016, net income actually dropped to $900. The company made less money, yet the EPS improved to $1.03. Wait, the company made less money, but the profitability per share went up. How is that not a massive red flag?
Because they used cash to buy back 125 shares of their own stock.
Oh, wow. They shrank the total pie, but because there were fewer slices, each remaining slice looked bigger.
Exactly. The underlying reality is the business got weaker, but management used excess cash to mask declining performance.
And they often do that because their own bonuses are tied to hitting EPS targets, right?
You got it. That's why a true analyst never just looks at EPS. You have to check if the underlying net income actually grew.
So what does this all mean? Wrapping this up, reading a balance sheet is basically like reading a company's diary. It tells you about their fears, like hoarding cash,
Yes,
their strategies, like using credit as a weapon, and their illusions, like manipulating inventory math or stock buybacks.
that's a great summary. But I want to leave you with a final point to ponder from the text. We've talked about cash, buildings, inventory, patents.
The physical stuff.
Right, but what about the employees? Companies spend billions recruiting and training people. Think about consulting firms, law firms, software companies.
Right, in those places, the employees are essentially the only valuable asset.
Exactly. Yet, because a human being cannot be owned or reliably valued under accounting rules, they don't show up. The single most critical driver of a modern company's success appears absolutely nowhere on the traditional balance sheet.
The invisible asset. That is wild to think about. So, to you listening, look at the companies you interact with today and ask yourself, what valuable assets are completely invisible on their books? Thanks for joining this deep dive.